Good evening, members. Welcome you all for this guidance note on accounting for share-based payments, revised 2020. To handle this session, we have an eminent speaker, none other than CA Suraj Palled. I request CA Nischal to welcome the speaker with bouquet.
Thank you, sir. Welcome. All the best.
Thank you, Nischal. Members, this is a very important guidance note. After it is revised, lot of startups and foreign companies having their subsidiaries in India, lot of ESOPs will be given to the employees. So maybe some of the shares are listed, some of the unlisted shares. There are so many issues. Very important topic. To handle this session, we have a Suraj Palled. Whatever queries, you can directly raise your question and ask him. With this, once again, welcome you all for this program. I request our secretary to give a brief introduction of the speaker.
Thank you, Chairman, for the welcome note. I take the privilege in introducing Mr. Suraj Palled, a qualified chartered accountant with zeal to learn and enthusiasm to deliver quality on task, highly organized individual who believes in creating diligence to every challenge, result-oriented professional with 5 years of experience in the field of auditing and assurance. Possesses a remarked track record of meeting assignments targets in an efficient and effective manner, dealing with internal teams and external customers. Currently, he is an assistant manager in Pricewaterhouse & Co. Chartered Accountants LLP. He is leading a team of 22 members ranging from article trainees to senior associates in planning and executing audits, understand and recommend on the operating effectiveness and efficiency of the client process and controls, financial modeling and analysis of financial statements using an analytical and statistical methodologies, application of accounting and auditing tools to ensure compliances with regulatory requirements of various statutory bodies. Primarily engaged on statutory audits, tax audits, GST audits, forensic audits, internal audits, and statutory certification required under the various statutory bodies. Engagement manager for clients ranging from newly incorporated startups to MNCs and companies listed on stock exchanges in India. He is also a professional coach. Also, he's conducted seminar for various practicing chartered accountants on the revised Schedule 3 and CARO 2020 at ICI Bellary, conducting skill development trainings for organized by Bellary District Chamber of Commerce and Industry during the year 21-22, conducted trainings for article trainees and newly qualified chartered accountants at PwC on topics relating to auditing standards, Ind AS and IFRS, designed and taught basics to accounting for Bachelor Commerce, designed and taught statistics and basic mathematics class 11, 12 students of Karnataka Board Pre-University. With this brief introduction, I present to you Mr. Suraj Palled. Over to you, Suraj.
Hello everyone, good evening. I firstly thank our chairman,
Suraj, you
CA
can take over.
and yeah, Pramod, is it audible? It is. Hello. Hello, Pramod, it's audible, right?
You are audible. Go ahead.
Okay, thanks, sir. Good evening, everyone. Firstly, I would like to thank our chairman, CA Srinivasati, and our secretary, Pramod Hegde, for giving me an opportunity to deliver on the guidance note on revised share-based payments. Also, I would like to thank all the participants who have joined virtually as well as physically over here. Uh, Yeah. Uh, so today in the next 2 hours we are going to discuss on the gist of guidance note issued on accounting for share-based payments, which was issued in September 2020 and which will be applicable from April 1st, 2021. So this is the agenda which we are going to discuss on in today's session. So first we will get to understand what is the introduction for this and why they have introduced this particular guidance note. This what all is included in this particular guidance note, what is specifically excluded in this guidance note, what are the key terminology used in this guidance note. So share-based payments, the different types of share-based payments which are available, and under share-based payments we have equity settled share-based payments and cash settled share-based payments, and we also discuss on a few reload features. Let it be modification to the terms of share-based payments, if there are any cancellation or settlement during the period, and also there might be share-based payments with cash alternatives among the group enterprises, share-based payments issued among the group enterprises by holding company to its subsidiaries or further, which we will discuss in the coming slides. Then if there are any ESPPs or ESOPs which are administered through a separate trust or similar vehicles, and what is the EPS implication on this particular share-based payments, then we will see what are the disclosure requirements as per the guidance note. And at the end, we are going to cover what is the difference between what is covered in this guidance note versus what is there as per the Ind AS, and we will also compare it with the earlier guidance note. So before this particular guidance note, which was issued in 2020, there was a guidance note on share-based payment which was covered, which was issued in 2005. All the companies following the accounting standards were using that guidance note as a reference for accounting and measurement of share-based payment. So this is the brief agenda on today's topic. Coming to the introduction. So this guidance note on share-based payments was issued in September 23rd, 2020. So earlier to this, there was a guidance note which was issued in 2005, and that was applicable mainly to the accounting standards client, which followed Division 1 of Schedule 3, which follows the Division 1 of Schedule 3. And considering the changes in the current companies and everything, the institute has thought that there should be a revision in terms of accounting and measurement of share-based payments. So this particular guidance note, yeah, the report. So this particular guidance note is issued and it will be effective from 1st April 2021, and this will be so also the ICA is in the progress of drafting a separate accounting standard for share-based payments, and until then this guidance note would be valid. Uh, so in today's world, what we see is many of the companies issues share-based payment related schemes to all of its employees, other than the normal salaries and all, just to maintain good corporate governance and to promote long-term shareholding by the company. So when we speak about share-based payments, we'll need to know what all are included in share-based payments. So the share-based payments majorly include, one is your employee stock option plan, which is commonly known as ESOPs, and this is one of the share-based payments which is issued by many of the companies to its employees, just in order to retain the employees. And also today's companies and startups feel that it is important for the employees as well to be part of the organization, to be part of the ownership of the organization, and also to ensure that people stay in the company for a very long period of time. They try to issue ESOPs instead of the salaries. And next is on employee stock purchase plan. So when we speak about employee stock purchase plan, it is the option given to the employees for the purchase of shares of the company. So they, just to give an example, a company might issue shares to its employees saying that if it is listed at 100 rupees in the stock market, they might give an option to its employee to purchase it at 80 rupees or 50 rupees or at a discounted rate. So these are covered under the employee stock purchase plan. And next we have stock appreciation right. Stock appreciation rights are something where the company grants the employees cash equivalent to the value of the shares. So the company might tell, okay, today the value of the share is say 100 rupees, and by end of year one, if they achieve this. Sorry, there was some connectivity issues. Yeah. Yeah. So we were discussing on the various share-based payments which were included. And here, speaking about the stock appreciation rights, when we say stock appreciation rights, the company might issue shares to the company might inform the employee saying that, for example, if the value of the share is 100 today and it exceeds beyond 200 after year one, then whatever is the excess, we would pay you equivalent to that of cash. So, for example, they might issue 10,000 shares to a particular employee and say that if it crosses 200 and let's say it crossed to 220 rupees, they would pay 20 rupees into 10,000 shares to that employee as an incentive for ensuring and making that the company grows in that manner. Also, this.
Stop sharing and share it again. Please don't.
Voice ಕೇಳಿಸ್ತಾ. Yeah. So this guidance note, so specifically this guidance note also includes share-based payments arrangement with non-employees. So when we see in the earlier guidance note, which was issued in 2005, that guidance note was specific to the employees itself, which covered, the ESOP, ESPP and SARs only. But this guidance note is vast enough to cover other than which is issued to employees also, which we will cover as part of our next slides. Yeah. So coming to the scope, wherein to what all schemes does this guidance note applies to? So first thing, this guidance note applies to all the employees. Let it be a whole-time director or a part-time director or any sort of employee. It is not like restricted saying that if they are in the top management, this particular guidance note doesn't apply also. So this guidance note applies to all type of employees. And also it applies to external supplier of goods or services. So the earlier guidance note was specific to employees itself, whereas this guidance note says that, like, for example, a supplier says that, okay, I'll provide you this one particular goods, and in return, you provide me shares equivalent to that. So this guidance note specifies what should be the accounting treatment, what should be the measurement, what are the disclosures required in terms of where the external supplier supplies goods or services. So when we say a supply of goods or services, it might be your inventory related purchase or any other external consultancy services which you have obtained from anybody, or purchase of any fixed asset. So it includes all the purchase of goods and services. This guidance note also covers group share-based payment scheme. So when I say group share-based payment scheme, there might be schemes like, say, for example, uh, so the holding company might have a subsidiaries. It might have more than one subsidiaries. and subsidiary 2, let us say subsidiary 2 has many employees. So holding company might directly issue shares to the employees of the subsidiaries without involving subsidiary 2 itself. So earlier, what we used to do is that when the holding company issues shares directly to the employees of the subsidiaries, wherein subsidiary 2 wasn't involved, then there was no need for the subsidiary to account it, because it was just a transaction between holding company and the employees of the subsidiaries. It was not in the agreement between the subsidiaries and the employees of subsidiaries. Hence, this wasn't covered earlier. But now this guidance note specifies what should be the accounting treatment in the books of our holding company, in the books of the subsidiary company, and in the books of the consolidated financial statements of the holding company. Yeah. So next is transactions with employee stock option trust and similar vehicles. So some of the companies might have a scheme wherein, like, they might maintain a separate trust. So we might have seen in many of our clients, like they might have formed a different separate trust for their gratuity purpose, for funding their gratuity or something. So in the similar way for ESOPs as well, companies would have a separate trust. They don't want to deal with this compliance part and all of this. So they might have a separate trust wherein on a regular basis, they might transfer the number of shares which they want to grant it to employees to a separate trust and want that trust to maintain. So this guidance note specifies what should be the accounting treatment in the books of the company. Even if the trust is maintained and everything is passed on, what are the various implications on the parent company which is issuing ESOPs. So this also covers to grant of employees of the other entity on merger of amalgamation. So these days it is very common to have merger and amalgamation between the companies. So let's say a company is acquiring one more company, then the company which is acquiring might say that I'll issue additional ESOPs or something to the employees of your company. So even those are considered as part of this amalgamation, irrespective of it mentioning, some of them might argue on this, saying that it was part of the merger agreement itself and it was part of the consideration. Even if it was part of the consideration, this is covered as per the guidance note issued under the ICA. And also if there is any cancellation or modification of SBP on account of amalgamation. So when there is any amalgamation, let it be your merger or acquisition and all, the earlier company might get closed. So there might be a cancellation of that particular ESOP plan and the new acquiring entity might issue their own ESOP plan. So this guidance note also covers on this particular thing. And next point is regarding the applicability. So there is a lot of confusion on this applicability. When should we take this guidance note as applicable? Because it was issued on September 23rd, 2020. So it mentions that whatever there are any plans with grant date subsequent to April 1, 2021, then this particular guidance note will be applicable. So say for example, there was an ESOP plan which was issued on 1st January 2021. The start date is 1st January 2021 and it might extend till 31st December 2021. And it might say that on 1st January 2022, the employees might exercise the shares. So here our date of applicability of this guidance note is 1/4/2021. So this guidance note says that the grant date should be this date or after this date. So if there is any ESOP or any plan issued before 1st April 2021, they need not apply this particular guidance note. So we'll need to see only for one checkpoint what is the grant date mentioned in the ESOP plan, and if the grant date is 1/4/2021 or post that, we will need to apply this guidance note. If the grant date is prior and even if the vesting period is continued, for example, say on 1st Jan 2021 itself, it was the grant date, and even if this ESOP would get exercised after 5 years or 10 years, this guidance note will not be applicable. So that has been made very clear in the guidance note, saying that it is the grant date where we will need to see for the applicability. Moving on to the next slide, what is out of scope of this guidance note? So we have mentioned what are all included in this particular guidance note. Now let us discuss on what is not included in this guidance note. So in the earlier slide, I have mentioned that, like, in case of merger or amalgamation, if the shares are issued to employees, then it is covered under this guidance note. But in case shares are issued for acquisition of net assets, say for example, the net assets acquired might be equivalent to some 100 or 1000 rupees, and we are issuing shares for acquisition of asset, then that is not covered under this guidance note. It leads to the purchase consideration, and it would be covered as part of our AS 14, that is that is on merger or amalgamation. So next, a transaction with an employee or other party in his capacity as a holder of shares. This will also not be covered as part of this guidance note. So if you are issuing ESOPs to an employee in capacity as an employee, then this guidance note is applicable. But say, for example, you are issuing shares to all the employees who had earlier shares in the same ratio. Yeah, similarly, like, if you are issuing a bonus share or if you are issuing a additional rights issue, then this particular guidance note will not be applicable. Only for a consideration of service received, if you issue any plan or ESOPs or anything, then this particular guidance note is applicable. Next is on the preferential allotment of shares to each employees at the time of IPO, considering the price and other terms are same as it is for the public. So recently we have seen many IPOs wherein, like, they might have reserved one particular portion of it for employees. Say 90% might be for public and the balance 10% might be reserved for the employees of the company. And we have recently seen the LIC IPO as well, wherein a part of it was reserved for its policy holders, a part of it was reserved for its employees, and then it was for public. So what this guidance note states is that if a company issues shares to its employee as part of the IPO, and there is a specific reservation of that, considering the terms and conditions are same as what you issue to the general public, then this guidance note is not applicable. But if you are issuing it at a discounted price or something, then this guidance note is applicable. So here, in case of LIC IPO, there was a discount issued to its policy holders and its employees. So considering the discount was issued, this guidance note will become applicable. Moving on to the next slide, that is on the key terms which we will be using as part of our presentation. So first is on the equity settled share-based payments. So equity settled share-based payment is something wherein, in consideration, when you receive any service or yeah. Equity settled share-based payment is something when you receive consideration, when you receive the services or goods from an external party, and when you settle them in equity shares of the company, then it would be termed as equity settled share-based payment. In case when you are giving cash, then that would be called as cash settled share-based payment. But here, in all the transaction, for sure, we would issue cash itself. When we purchase goods or services, we would issue cash itself. But here, the difference is that if the cash consideration which you pay is linked to the value of the equity shares, then it would be termed as cash settled share-based payment. Next is on the grant date. So grant date is something which we are discussing from the beginning of our presentation, and which we will also discuss on this throughout our presentation. So grant date is the date on which the ESOPs or any other share-based payments are issued to the employees. And that is the date when what we consider for the measurement and for the valuation and everything which we will discuss further. And next is on the vesting conditions. So when when a company or an employer issues shares to its employee, it doesn't just issue shares saying that I'm issuing shares for you at this particular price, you can purchase it tomorrow. There might be some conditions which they might issue. They might say, for example, you'll need to stay in this company for the next 3 years for you to exercise this particular options or something. So that period from the date of issue, that is the grant date, till the date of exercise. So here in our case, I said that on first day, the employer has issued shares to employees saying that you will need to stay in the company for the next 3 years. That 3 years would be would be considered as the vesting period. And vesting condition is, this is the condition. So here what I have mentioned is regarding the service condition, which says that you will need to provide services to the company for the next 3 years. And next is on the performance condition. So some companies also issue shares to its employees saying that, like, you will need to bring the target of the company, or you'll need to increase the sales year on year by 10%, 20%. This would be known as non-market performance conditions. So they might also issue market performance conditions saying that, like, the shares of the company should, share price of the company should increase by 20% year on year, or the EBITDA of the company should increase by this much, or the intrinsic value of the share compared to its industry's intrinsic value should improve by this much. So that would be termed as market performance condition. So in our further discussion, we will try to understand how we'll need to deal with each of these conditions, how we will need to factor in our accounting thing. Next is on the exercise period. So here, in the same example which I quoted earlier, so they say that, like, today is day one wherein the company has issued shares, and it says that by you'll need to stay in the company for the next 3 years, and also it gives time for the employees to purchase shares for the next 3 years. Say, so if I will have to tell, on 1/4/2021 is the grant date, wherein the company issues shares to its employees, saying that they will need to stay in the company for the next 3 years. That is till 1/4/2024. So after this, the company says that from 1/4/2024, for the next 3 years, you can use it. That is till 1/4/2027. So this will be termed as the grant date. The 3 years, that is from 1/4/2022 to 1/4/2021 to 1/4/2024. This period will be termed as our vesting period. So this is the period where the employee needs to satisfy the conditions. Let it be a market condition, or let it be a non-market condition, or let it be a service condition, which says that they will need to stay in the organization. So this will be considered as the exercise date, the date on which the employee is eligible to exercise. And this period from 1st April 2024 till 1st April 2021, this period of 3 years will be considered as the exercise period. That is a period allowed to employee to exercise. So if an employee comes and asks for purchase of shares subsequent to 1/4/2027, that will not be considered. So the whole of this will be decided in the ESOP plan itself when it is issued to the employee. So in these recent days, most of the startups, right, so they are unable to pay most everything in cash to its employee, and just to compensate people and to encourage people to join them and stay in them, they promise them to be part of the organization's ownership by issuing ESOPs or the other share-based payment schemes. So these are the key terms which we have discussed and which we will be using in our further presentation. Next, coming to the accounting aspect. So how we are going to account our share-based payments. So in terms of accounting, there are two methods of accounting which can be followed and which is allowed as per the guidance note. One is on the fair value method and other is on the intrinsic value method, which the guidance note allows. So let us say an employer issues ESOP, or he issues ESOP on 1/4/2021 itself. And he says that so he has an option on that. So on that particular day, he will need to decide whether he is going to follow fair value accounting or he is going to follow intrinsic value of method of accounting. So here are the key difference between the fair value method and the intrinsic value method. In the fair value method, what happens is that the employer needs to determine the fair value of the option. And in intrinsic value method, intrinsic value will be the difference between the share price and the value of the option. So here I can give you one particular example. Say employer has issued 10,000 shares to its employee, 10,000 shares to its employee, saying that he can purchase the shares at 50 rupees in future. The shares of the company at 50 rupees after 3 years. So on this particular day, the employer needs to value the value of the option. So here, this whole term, whatever he is issuing, 10,000 shares at 50 rupees, this will be considered as the share option. So the option of the share, if the company is issuing at 50, then what the employer needs to do is after 3 years, he'll need to estimate what will be the share price. And based on that, he will need to estimate what is the price of this option. So considering various discounting factor, volatility factor and everything, he will need to get a valuation done on the date of grant. That is on 1/4/2021. And he should value the option. Say the option price is 7 rupees. And on the and he will need to he'll need to incur this 7 rupees cost over the next period, over the vesting period, which we will discuss further. Or there is a second option wherein the company needs to value the intrinsic value of the share. So here in terms of fair value, they will need to calculate the fair value of the option, which will be just the option price, that's it. Whereas in intrinsic value, they'll need to value the intrinsic value of the whole share, saying that they might estimate that after 3 years, the price of the share might be equal to say 60 rupees. Then the intrinsic value will be equal to the future share price minus whatever is the exercise price. So that will be 10 rupees. This is the difference between fair value and intrinsic value. And one more difference, if we will need to see what is the other difference between these two, is that in fair value, the valuation is done one time. That is at the date of grant itself. But when we see the intrinsic value of valuation, then the valuation needs to be done at end of each balance sheet date or the reporting period. And in most of the cases here, it would be 31st March itself. So that is one advantage of going for fair value. And also the recommendation provided by guidance note is to use fair value method of accounting rather than the intrinsic value of accounting. Yeah. And next, so let us see what are the different types of share-based payments which an employer can issue to its employees. So here we have 4 types of share-based payments which an employer can issue to its employees. First one is equity settled share-based payments. Equity settled share-based payments are those payments wherein the employer gives the option to employee. The employer says to employee to purchase shares at his option. It is not a it's not a compulsion or an obligation for an employee to purchase, but it's a right. He can either exercise that particular option or he can leave it. And in terms of cash settled share-based payment, it's a share-based payment arrangement wherein the employer promises to pay cash equivalent to the share price. So for example, an employer issues shares, ESOP to its employees, saying that he can exercise at 50 rupees in future after 3 years. Say the share price of the company is say 60 or 70 rupees, then the employer, if it's an equity settled share-based payment, the employee has to compulsorily purchase the shares of the company at 50 rupees, wherein in the market it might be available for 60 rupees. He can purchase with the company at a pre-agreed price of 50 rupees. And in terms of cash settled share-based payment, here it is the obligation of the company to issue the cash itself. So the market price was 60 rupees and the employer has promised to pay at 50 rupees. So the difference of 10 rupees, whatever is between the exercise price and the actual market value, that will be paid to the employee. And next term is regarding the share-based payment with cash alternatives. So here cash alternative is something wherein it is given, the option is given either to an employee or the employer might have the option. So when the option is given to employee might either choose to take shares in future or they can take in cash. So you might have a question saying that why do an employee want to take it in equity when he can take it in cash? So here most of the companies today, what they are doing is they are forming a plan in such a way that if they are going to take shares of the company, if they are going to settle it in equity, then they would get 1,200 shares. Or if they are going to settle it in cash, they'll get it for 1,000 shares. That's it. So they're maintaining that difference so that they can promote the employees. So it would be at the decision of the employee either to go for equity settled or to remain with a cash settled share-based payment. And next option is share-based payment with cash alternative with option with the employer. So sometimes the employer itself might not be sure at the beginning, saying that whether they'll have sufficient cash. So they don't want to dilute the ownership of the company, but at the same time, they're not sure whether they might have the cash at the end of the exercise period to pay. Right. So in that situation, what the company does is that they will put it as with cash alternative with the option of the employer. Employer will have the option to decide at the end of the period whether it will be settled in cash or in equity. So this option which is given will be given at the grant date itself to all the employees, and the actual option would be decided either by employee or the employer at the exercise date. Let it be after 3 years or 4 years till the end of exercise period. Whenever the employee want to exercise, then at that point in time, they will need to decide on at which mode they need to exercise this. So yeah, so we will discuss on each of these schemes. How do we account for, and what is the measurement criteria, recognition criteria, what are the disclosures required for each of these share-based payments with a few examples as well. So first, let us discuss about equity settled share-based payments. So in our initial discussion, we have mentioned that share-based payments is not just for employees alone. This guidance note covers the share-based payment on receipt of goods or services from a external vendor. So in terms of recognition, what is the point of recognition of your share-based payments? In terms of goods. So for example, let's say a vendor sells goods to us, then we will, instead of paying it in cash, we might have issued equity shares. At what point in time should we recognize that particular? So we will need to recognize that when the goods have been received. So in terms of fixed assets and everything, you might say that, okay, we are capitalizing on that particular day, we'll receive. But in terms of inventory, you might come back saying that that might be used over a period of next 2 years, 3 years. Even then, we will need to recognize for this share-based payment transaction on the date when we receive the good itself. And next is on service received from the employees. So when we are receiving the service from the employees and we are issuing the equity shares, when do we consider that, like, this ESOPs are relating to? So when we are paying them in equity, it means that we are paying them additionally. That means that we are receiving some service to them. So which period should we consider? Should we consider the period prior to our grant date itself, saying that we have already received that service, or which period should we consider? So we will need to consider the vesting period. That is the date when we have granted the ESOPs till the date of exercise. That is the vesting period. We will need to consider and recognize this cost over the vesting period. And next is on the services to others. So services, the first thing we have discussed on goods, and next thing we have discussed services from which we have received from employees, and we might also receive services from others, let it be our consultants or somebody, and we might issue them in shares instead of paying it in cash. So most of the startups nowadays, what they do, wherein they have a regular marketing related services to take from, instead of paying them in cash, they are paying them in shares itself, saying that we'll pay you in shares currently, and considering they don't have enough liquid amount. So when is it right time to recognize the ESOP related cost? So the right time to recognize this ESOP related cost and transactions is when you receive that particular service. If that service is received over a period of 1 year, then the ESOP as well, or the share-based payment, should be recognized over a period of 1 year. So this is on the recognition criteria, the point of recognition. What will be the point of recognition and passing an entry for share-based payments? So next is on the measurement. At what is the value at which we recognize our share-based payment transactions? So this is a priority which we follow for recognition. First is we see the fair value of goods or service received as on the grant date. Say, let us assume we have received one particular good. We will first need to see what is the market value of that particular good. Is it ascertainable? If it is ascertainable, we will need to use that particular value as the value of the shares. In case we are unable to determine the value of the good or service, the second option will be fair value of equity instruments granted. So here the fair value of equity instruments granted can only be through the valuation which we get it on the shares and all. So the next point, even if we are unable to value the shares of the equity instruments on the grant date, we will need to go for intrinsic value of measurement, wherein on the grant date we will measure the value of shares, whatever it is, and at the end of each reporting period we will see what is the actual value of the shares, and we will make necessary changes at the end of the reporting period.
Intrinsic value, nothing but book value.
Sorry?
Book value is increased.
Correct. Intrinsic value of the whole share. Correct.
Measurement.
Hmm.
There's something called as it's a forfeiture of options.
Yeah.
So the adjustment is done for that.
Yeah, in case of forfeiture, it would be, yes. So forfeiture forfeiture might be due to different reasons. One, forfeiture, the company itself can cancel those particular shares, and because they want to change the plan or something. The second type of forfeiture might be due to exit of employee. Employee might exit during the period, and because of that, you might forfeiture. So we will discuss on each of those accounting treatment. On cancellation, how do we deal with it, and on forfeiture, how do we deal with each of those.
On an annual basis, to keep on adding the provisioning in the book. Right?
Correct.
At that time, this measurement of forfeiture has to be repeated.
So that will get, here how the actual measurement happens is, say for example, on the first date you have estimated 10,000 shares are outstanding and the value per share is 15 rupees over the period of 3 years. So the value of the whole option will be 10,000 rupees into your 15 rupees, which will come to 1,50,000 rupees. You are recognizing only 50,000 cost in the first year. At the end of second year, there might be some employees who might have left. Because of that, the number of shares might have decreased to 9,000. Then what will happen? We will calculate the total value of the plan. So that will be 9,000 rupees into 15 rupees, which will come to around 1,35,000. So in the second year, so basically for the second year, over the period of 2 years, you should have recognized 2/3 of it. So whatever is the differential amount, that will get reflected in your P&L account itself. You need not move from one particular reserve to another reserve.
It's not based on the company estimates.
Okay.
Based on their turnaround in the employees.
Yes.
Employees which may become say 80. Obviously,
Correct.
80 by end of third year.
Correct.
So
that needs to be factored.
today itself company can provide only for 80.
Yes, company can provide. I will take you through. I have a similar example on that. I will take you through in that. Yeah. So the estimation needs to be made at end of reporting period.
Actual report is required.
Sorry?
Does it require any actual report or?
No, the actuarial report is not required for estimating. So there are a few estimates which needs to be considered by the valuer, saying what is the value. And for a few estimates, the valuer need not consider, and the auditor or the management needs to consider at each reporting period. So here we have the vesting period. So vesting period, as I earlier discussed, there are three type of vesting period. One is the length of the service period. That is, say that the employee must stay in organization for next 3 years, or this particular target must be achieved over the next 3 years or so. And we have performance conditions. Performance conditions are again two types. One is non-market conditions and one is market conditions. So as you have asked in the earlier, so the estimation relating to market conditions needs to be estimated at the grant date itself. When you give the base data to your valuer, you will need to give all the terms and conditions. In that terms and conditions, you will not give the expected attrition over the next 3 years. So the valuer will not consider that particular attrition related. He will just consider the value of the option. Other than the market conditions, whatever it is, let it be them achieving the percentage of target. You might say to an employee, like, you'll need to achieve 15% target year on year. And you estimate that out of 100 employees, 80% of the employees might achieve this particular target. So all these conditions actually cannot consider in this evaluation. This needs to be considered by the management at end of each reporting period, and they'll need to make the calculation.
Valuation is done by actuary or registered value?
It should be done by a registered valuer.
And does this process require merchant banking valuation as well as per Income Tax Act, or is it fine without merchant banking valuation?
So that will be required as per the Income Tax Act. Yes, yes, it is required.
Because anyways premium will be.
Correct, premium will be there. So regarding the non-market conditions, valuer will anyways not factor those items in his valuation report. But when it comes to market valuation, saying that the share price of the company should increase by 20%, or the intrinsic value of the share should be this ratio when the intrinsic value of the whole industry is this ratio. All those conditions will be considered by the valuer. Whereas the management will consider the first two, that is, one is the length of the service period, and the performance condition should be considered by management, and it should be reassessed at end of each balance sheet.
Even listed shares need to be valued by valuers?
Yes, it should be valued. It should be valued by a SEBI registered valuer. Yeah. So till here we have discussed on the vesting period, and now we will discuss on after vesting date. So say the vesting period has ended and it's time for the employee to exercise the shares. and you assume that the actual market value of the share decreased or something, you shouldn't make any adjustment to that. Adjustment should be made only in two cases. One is the adjustment should be made from moving from equity to your reserves. That is at the time of, like, if the employee exercises those particular shares, or if the employee exits the company after the vesting period. So if the employee exits the company within the vesting period, right, that will be factored in your cost itself. So you might have accrued that particular expense in first year. Say he has left in the second year. So that will be adjusted in the cost for the second year total expense for the year. If the employee has exited after the vesting period, only then you will transfer it from your reserve, from one reserve to another reserve.
If employee exits after the vesting period and not opted for this.
Yeah, then you will move from,
The entry, expenditure gain.
sorry,
Employee doesn't opt for it after the vesting period.
correct.
That's great.
No, you can't pass a reversal entry. It needs to be transferred to one reserve, one forfeiture, that's it. The forfeiture which you have mentioned, that will be transferred from one reserve to another reserve, and it will not have impact on my P&L. If it is during the vesting period, then it will have impact on my P&L, which will get adjusted in the cost. Yes, it will be a netto.
After vesting period, because they are not exercised, then go to
Correct.
what is the reserve on that? Forfeiture.
No. So when you pass the entry, initially it will be ESOP reserves. It will go from there to your general reserve.
General.
Yeah, free reserve. Anyways, this will not have any impact on your taxation because all these are notional entries and they will be disallowed in the tax calculation initially. Yeah. So we will get an understanding of how we have treatment of vesting conditions by understanding each of these examples. So on the first example, let us assume at the beginning of year one, an enterprise grants 300 options to its 1,000 employees. The contractual life comprising the vesting period and exercise period of the option granted is 6 years. And these are the other relevant facts. Say the vesting period is 3 years, and after the vesting period overs, the exercise period is for 3 years, and the exercise price is 50 rupees, and the market price, that is on the date of grant, is also 50 rupees. And at the grant date, the expected forfeiture per annum considered is to be 3%. And based on the valuation which they have taken, the fair value of the option is 15 rupees per option. So here the valuation will be taken only at the beginning of the grant, that is on the grant date, that's it. In terms when they follow fair value accounting, they need not take the valuation at end of each period. So this is the criteria at the beginning of the year. So when we see the actual forfeiture during the year one, we have estimated initially 3%, but the actual forfeiture during year one was 5%. And at the end of the year one, the enterprise still expects that the actual forfeiture would be average 3% over the total period of 3 years. And during year two, when we see, the management decides that the rate of forfeiture is likely continue to increase, and the expected forfeiture rate for the entire award, they have changed it to 6% at the end of year two. It is also assumed that 840 employees have actually completed year three. So at the year three, at end of year three, the actual employees who completed were 848. So when we see the accounting terms, how we actually value and measure this particular ESOP on the grant date. So on the grant date, enterprise expected that there is a 3% attrition year on year, and they have issued ESOPs to 300 employees. So they have 300 employees. 300 employees were issued with ESOPs, and for 300 employees they had 1,000 shares were issued, and they expected 3% attrition. So factoring all of those, the total number of options which they expect to vest comes to 2,73,000. This is at the end of year one. They don't know what is the actual in the future, but they knew what was the actual at end of year one, but they still considered the average attrition rate to be 3% over the whole period of 3 years, and they have factored in that, and they have considered the total number of options which they expect to vest at the end of 3 years would be 2,73,000. So here what they have calculated is that for this whole 2,73,000, the total cost which the company needs to incur would be into 15 rupees per option, which will come to 41,07,030 rupees. So this total 41 lakh should be straight line for the next 3 years. In the first year, we will recognize 1/3. By second year, we should have recognized 2/3, and by end of the period, whole of this expense. So accordingly, this whole amount has been divided by 3, and 13,69,000 has been recognized during the first year. When we go to the year 2, so year 2, what we have seen is that the company has revised its estimates. So as I have earlier mentioned, the company needs to assess the assumptions, non-market conditions, that is, let it be your attrition rate or the exercise ratio or something, at end of each reporting period. So at end of year 2, they have estimated that 6% attrition would be there. So considering that, they have recalculated the number of options which would vest at the end of year 3. That will come to your 3 lakh into 94% for 3 years, which would come to 2,49,175. And they have estimated the total cost to be incurred over the period of 3 years will be this 2,49,000 shares into 15 rupees, which will come to your 37 lakh. And for 2 years, cumulatively for 2 years, they should have recognized in total 24,91,000. That is your total number of shares which they expect to vest into 2/3. So already in year 1, they have recognized this 13,69,000. Balance will be recognized in year 2. So this will actually
Revising this estimate, does it require any valuation again?
no revising this estimate. Yes, it is management view on estimation, and it's the auditor's responsibility to validate this. Let it be on what basis they are bringing in this change in estimation, which was earlier 3 and now they've changed it to 6. So this will actually, this will factor in that additional 3%. If you see earlier it was 97, right? Now it has come to 93. So the cost would have been higher itself because of the forfeiture. It got netted off, and we are recognizing a lower cost in current year. It has been netted off. So we need not move something from our general reserve to the, ESOP reserve to our general reserve. And when we see the year 3, that is the end of the period, after the whole vesting period is completed, we have considered the actual number of employees who have completed is 840 employees. So here the actual number of options which have vested would be 840 employees into 300 options, which will come to 2,52,000. And this is the total cost which needs to be recognized, that is 37,80,000. And when we see the total expense which was recognized in year 1 and 2, it was 13 lakh was recognized and 11 lakh was recognized, totaling to 24.91 lakhs. The balance expense would be recognized in in year 3, that is 12,88,000. So here the accounting entry which we pass at end of each year is that we will debit the expenses, whatever expense we have, and we will credit a stock option outstanding account. So stock option outstanding account is an account which we create to just move the year on year whatever expense we are accruing, and it will be presented in between share capital and my reserves and surplus on the face of balance sheet.
But it's shareholder funds.
Yes. It will be part of my shareholders fund itself.
But it doesn't come under reserves.
Correct. So once this year 3 has been completed, then the exercise period would start. So let us assume some employees exercise after that 3 years itself. Then what entry would be passed is that whatever portion the employee has exercised, that portion of expense will be moved from my ESOP reserve account to my, let it be securities premium or share capital in that particular ratio. And the balance, if towards the end of 3 years, if the employee has not exercised it, then we will consider it as a forfeiture. Then we will move it to general reserve. So during the vesting period, nothing will be moved.
When he exercises, where do we read it?
A securities premium.
Securities premium.
Yes.
If we don't have
So for example, let us say ESOP cost. Sorry. No. So for example, we have. Yeah. So for example, let us assume we have incurred 15 rupees. Let us assume we have incurred 15 rupees cost per ESOP over the period of 3 years. And the plan states that they will need to purchase at 50 rupees. Right. And the let us assume on that particular day, the actual market price of the share is 60 rupees. So here the employee is paying us 15 rupees, and the premium already for which we have recognized cost is 15 rupees, and our share price, each share price is 10 rupees. So in total what we are doing, we are receiving 50 rupees from employees, and we have already received 15 rupees in terms of the service received from him, and we have incurred that particular cost. So in total we are receiving 65 rupees from the employee. And the actual cost per share. The value per share is 10 rupees and the balance of 55 rupees will be hit to my securities premium. So what entry we would pass is, he would pay us cash for 50 rupees. We would debit our cash or bank for 50 rupees, and whatever we have 15 rupees in our reserves, ESOP reserve account, that reserve will be hit by 15 rupees, and to my equity share capital will be 10 rupees, and my securities premium will be the balance 55 rupees. Yeah.
Company is issuing ESOP and
Yeah, that is there. So within the group, yeah, it is there. Okay, so here in the initial we have discussed on the condition, that is a vesting condition, saying that the employee needs to stay in the company for 3 years and all. So there might be some other conditions like, the performance condition. This is an example of that performance condition, which states that 100 stocks would be granted to each of its 500 employees, condition upon which they have changed the vesting condition itself. They said that the option will vest at the end of year 1 if the earning of the enterprise increases by more than 18%. So they can exercise that particular share. If you ensure that the earnings of company increase by 18%, then you can exercise the shares at end of year 1 itself. If not, at the end of year 2, if the earnings increase by an average of 13%, then you can exercise at the end of year 2. And if even this is not achieved, then at end of year 3, if the earnings increase by more than average of 3% over the period of 3 years. So this is the plan which they have given as per the initial ESOP plan given to employees. And they have also valued the fair value of the option as on the grant date, that is 30 rupees. So when they are valuing this fair value, right, they won't take into consideration what is the the estimated probability of the employee achieving that particular target. That is the management responsibility to value at end of each reporting period. So year 1, let us say year 1, by end of year 1, the earnings have increased by 14%, but the target was to increase by 18%. If it was increased by 18%, they would have got it. But it was increase, I mean, the increase was only by 14% and 30 employees have left the organization. So the enterprise expects that earnings will continue to increase at similar rate. So if it increases at similar rate, then the average at year 2 will be 14%, and they expect, so as at year 1, as at the end of year 1, the entity expects that the vesting period will be 2 years, because they will achieve at the end of 2 years. So the enterprise expects that a further 30 employees will leave during year 2, and therefore expect option will vest to 440 employees at end of year 2. So this is the at end of year 2, these are the estimates which the company makes. And next, going to year 3, at end of year 3, 23, year 2. So by end of year 2, what is the actual scenario is that the actual increase was only by 10%. Taking it, so year 1 it was 14 and year 2 it was only 10%. So because of this, the average has come to 12% and not 13%. They did not achieve this even in year 2. So they will need to re-estimate their all the estimates and see if they can achieve by year 3. So they estimate that the earnings will achieve by, they will achieve the earnings by year 3, and it is going to vest by end of year 3. And these are the actuals in year 3. So by end of year 3, 23 employees have left the organization, and earnings of the enterprise have increased by 8%, resulting in an average increase of 10.67, wherein the target was achieved. So ideally, the options would be vested at end of year 3 only. So when we see how the accounting is done at each year end, so when we see at the end of year 1, right, they expected that over a period of 2 years, they will achieve it. So when we see from a standalone year 1 point of view, the total period, vesting period of this will be 2 years. So then we have estimated that total employees would be 440 after considering the year 1 and year 2 attrition. So the number of options which were expected to vest is 10,000 employees, 10,000 shares into 1,000 shares into 440 employees, which will come to 44,000 shares. So we have estimated that the fair value of options were 30 rupees, and considering at year 1, the total vesting period was 2 years, will incur 50% of the cost. We divide the total cost by 2 and we take that to P&L. So when we see the year 2 or the actuals in year 2, they couldn't vest it in year 2, and they have revised the estimate, and they estimate that everything would be in year 3. So considering year 3 and the attrition rate and all, we will need to estimate what will be the total ESOP cost for the whole period of 3 years, and we should ensure it should be apportioned over 2 years. So when we estimate the total cost, which will come to 12,51,000, and that should be apportioned over 2 years, and now considering 2 years have been completed, 2/3 of it should have already been incurred. And in year 1, we have already incurred a higher amount. So year 2, we will incur the balance amount. And when
Okay, sir. The end of year 2, the company estimates there is no possibility to achieve it in year 3. Then what?
okay, yeah. So at year 2,
They estimate it's impossible to, let's assume year 2 it became 6% and the market is
Correct.
lower, and they estimate it will never happen.
yeah. So in that, the guidance note says that whatever cost you have recognized, you can never reverse it in your vesting period.
No.
So even if your estimate
But
goes
they did
negative,
not, put any further
further cost, you need not accrue any further cost, but you can't reverse that.
You can't reverse it to zero.
Correct. You can't reverse it and make it positive and make it to 0. So there is no scenario wherein, like, other than this forfeiture where adjustment happens, wherein you will create an income in your P&L and reduce it from your ESOP reserve account.
Basically, we are treating the P&L as an expenditure, but we are not bringing it back to income, though employees.
Yeah, though your estimate changes and you say that, like, yes, taxes.
Not to give it an income.
No, company cannot. So the guidance note also mentions one more thing. Also, there is a regulation by Companies Act saying that the employee cannot issue or make any amendment to ESOP plans which are determinantal to the employees. Say they have issued 100 stocks to them, and at the end of year 2 they say, no, I don't want to issue 100, I'll issue 50. That is not against. That will be against the employees, and it is not allowed as per the Act.
So whatever is the promise should be done.
Promise should be given. Either they can still change for, like, saying that this 100 can become 200. That will lead to modification or cancellation of this plan and giving a new
Can the
plan.
period be increased?
Sorry?
Can the vesting period be increased?
No, that will again lead to determinantal.
So it will not be.
Yes, yes. As per company. So here it is.
Once we
Yeah.
issue this thing, is it to be registered anywhere when a software has been declared?
Mhm.
Does it have any filings with the ROC?
Nothing else.
There's no documentation.
No documentary evidences. But in case of listed and all, they will need to have a committee.
Right.
They will need to.
Non-listed,
Yes, there is nothing
no
regulatory. Yes. Correct.
Of course, something will come.
Yeah. So this example is as well the same as the earlier example, but here the only thing is that the exercise price varies. Say they say that, like, if you achieve 20% increase, then your exercise price will be 30. If you take the growth to more than 40%, then your exercise price will be 20. So here it is all the same about how we estimate it. At the end of each reporting period, the company needs to estimate to what extent they will achieve it. They'll need to estimate what will be the exercise price. And based on that, they will need to calculate at end of the period and accrue that particular expense.
Can they increase in excess price?
Uh, sorry. Okay.
By end of year 3, can they make the excise price to 100?
No, that will again be determinantal to the employees.
You said now.
Yeah, so it can be reduced. They can, no, in the initial plan itself, they can tell, like, saying that, if you achieve 20% target, your exercise price will be 50. If you achieve 30% target, your exercise price will be 20 rupees. They can reduce it, yes.
In the initial plan.
In the initial plan itself. So also later on they can do if it is not determinantal. So this is how we, like, if there is change in estimation. So here, for example, here what has actually happened is that in the first 2 years, they have considered the exercise price. Based on the exercise price, they have considered a higher exercise price. So they had a higher value. And later on, they expected the employees to achieve a higher target, because of which they have changed the exercise price and the fair value of it. Because of that, they have a lower cost. So also there is one more thing. I mean, these are all different change in the conditions, performance condition. We have seen vesting period. We have seen the number of options might change. We have seen the exercise price might change. And all. So even there might be a case wherein the number of options also might vary, saying that if you achieve this much, the options might increase. You might receive more options. They might have set a ratio. So the accounting for all of this will
Number.
sorry
Instead of amount, number. Of
number. Yes. So next is the example wherein the grant is with market condition. Say like, you have issued ESOPs to your employees saying that if the share price is this much or if it is increased by 15% or 20%. So all those factors, you shouldn't estimate it at end of each reporting period. So what we have mentioned is that only non-market conditions like this, your attrition rate or the possibility of the employee exercising that shares, all those conditions can be estimated by the management, but market conditions shouldn't be estimated by it. They should be considered by the valuer itself at the time of valuing the ESOP. So whatever is a market conditions, you shouldn't consider it. You should keep it aside and you should accrue your expense on year basis.
I know that my employee will not opt for it because there is no option to sell it.
Correct.
So I give him an option. I certainly know that. Okay, maybe 80% of people may not.
Okay.
So at that time, can I provide only for 20%?
No. So we have an example as to how to account in case of like, if there is an option with an employee. So then we will need to create a liability portion and equity portion as well, wherein we have an example. I'll cover how much should be hit to my reserve account and how much.
Year on year, when I count for the provisioning.
See, year on year, your cost will be for sure the same.
No, year on year, when I know that my employee category will not opt for it, only my director will not.
Okay. No, that estimate cannot be made actually. So whether the employee will select a cash based or an equity based, you will not have a right to estimate that.
That is meaning that let's assume we have issued it for 10 people. Out of the 10, 2 people are directors, 8 people are employees, and it's a closely held
Private limited company. Okay.
And they clearly know that the 8 employees will never opt for it.
Opt for.
Because it cannot be sold in the open market or
Correct.
to someone else.
Correct.
So his point is, can I estimate that 80% will not opt?
No, that estimate cannot be made. We will need to account for both of it.
What was the forfeiture portion in the first example? That also handles the same thing, right?
No, this is correct. This is completely equity. So this accounting treatment is only for completely equity settled. No, correct. So then there will not be an option itself, right? Yeah, I mean that will be considered. So you're telling that.
It's an equity settled state.
Okay.
Share-based payment. And I'm giving it for an example, 10 employees, of which 2 are directors, and 2 directors may opt because they are in the position of director. Others are in the position of employees. If they don't have an option to sell it, only either the person, the second shareholder can buy it, or else they have to keep it as it is.
Correct.
And obviously, it will be a higher exercise price, not at 10 rupees, 10, 15 rupees, or 20 rupees.
Okay.
So they not be interested to buy at all.
Okay. Yeah, that can be factored as part of our attrition percentage itself, and we can.
Attrition percentage is 80% be there. Like I know it's 22 people.
2 people will opt
8
it.
people may not come because they're employee category. So can I make it at 80%? Reduce the provision to 20%.
I mean, on a prudent basis, I think company should estimate it at a lower percentage itself. And if they have any past history of it, supporting that, people might not exercise and we had the same issue in the earlier, then they can create a higher attrition. But it will be, I think, a difficult task for us as well to validate that particular percentage.
Might not, auditor also might not agree.
Yeah.
Mainly, I assume, or should not agree.
First, keep increasing.
It will just be like hitting my P&L.
Increasing the provision. So it's
Correct. I agree. Correct. So, I mean.
And I put it in a different reserve and then go into
General reserve.
after the listing period.
Mm-hmm.
So until then, I have declared a reduced P&L in my
Correct. We have shown a lower profit just because of this.
And another thing, the ESOP scheme can be different from one set of employees to other set of employees to director.
Yes. That can be a different plan.
They should-
They can have a different plans.
There is no.
Yeah. Within the same plan itself, you can issue different number of shares to different. So it's all plan will be a standard thing, saying that it might be a graded vesting. 10% might vest in first year, 20% in second year, 30% in third year, and that will be a main set of plan. And for one employee, they might issue 1 lakh shares, another employee 2 lakh shares.
So based on
And the
the
exercise price also vary for each employee.
Sorry,
Exercise price also vary for employees.
based on the initial plan. So in the plan, they will need to mention the exercise price. So that will constitute a different plan again.
A category is for B category is 30 rupees.
Yes. Again, you'll need to get a different valuation done. That's it. Because the exercise price is
valuation is share valuation remains the same, right?
it's about the option valuation. So it's the option valuation. For example, at end of third year, you're estimating that the share price is 60 rupees. But assume that for A employee, he will need to pay 50 rupees cash. But for B employee, he'll need to pay only 40 rupees cash. So it means that the balance 10 rupees in terms of A employee, we are receiving from him in terms of the service received. But in terms of employee B, where he'll need to pay us lower rupees, it means that we are receiving 15 rupees from him in terms of services. So the fair value
Cost to be recognized.
will be higher. Correct.
That valuation.
Yes. Yeah. So also there might be a situation wherein a company might issue a reload feature to all of its employees, saying that once you exercise this particular ESOPs, then automatically a new set of ESOPs might be given to you. And that would be mentioned in the initial plan itself. Even though that is mentioned, that will not be considered for the initial valuation, and it will be considered as a separate plan itself. Say, for example, to employee one, they might give 1 lakh shares will be vested over 1, 2, 3, 4 years. And after fourth year, after all the 4 years get completed, by end of 4 year, he'll get 1 lakh more shares for the next 4 years. So when we are considering the valuation or hitting my P&L, we will need to take only the first 4 years and hit my P&L. Only after this first 4 years, the next 1 lakh should be considered, and that will be considered as a different plan itself. Yeah. So next is on the modification to terms. So there might be, as you have rightly mentioned earlier, there might be some places wherein they can modify, which is favorable to employees, saying that at end of year 2, they might decrease from 16 rupees to 12 rupees or from 15 rupees to 10 rupees, whatever it is, or they can issue additional number of shares. So we will need to see how do we account for that particular modification. So initially, for example, let's say 16 rupees was there for a period of 3 years. And then what we would have done is we would have taken that cost for 3 years. We would have taken the 1/3 of that cost in first year, 2/3 in second year, and one more, whatever it is, the balance in third year. So if there is a modification in year 2, will we consider that modification as part of this plan itself, or should that be apportioned equally to 2 years? So that particular modification should be apportioned to year 2 and year 3 only. Prospective. It can't be retrospectively saying that. Yeah, so here is the example to modification. So here at beginning of year 1, enterprise grants 100 stock options to each of its 500 employees. The grant is conditional upon employee remaining in service over the next 3 years. The enterprise estimates that fair value of each option is 15, and on the basis of weighted average probability, the enterprise estimates that 100 employees will leave during the 3-year period, and therefore they will forfeit those number of rights. Suppose that 40 employees, this is the actual, suppose 40 employees leave during year 1. Also suppose by end of year 1, share price of the enterprise has dropped. So for example, the share price in the initial period was 50 rupees, and they might have issued an option to an employee to exercise price at 30 rupees, you say. But at end of year 1, the company share price itself has decreased to 30 rupees. Then there will be no point in this particular ESOP. At that point in time, the company might give it at a still more discounted price, which is a beneficial to the company itself. So in this particular example, the same thing happened, wherein the share price of the company has decreased and the employer has decreased the exercise price at the end of year 1. and the enterprise has repriced its stock option. So if we see how the calculation is done, so at the year one, if we see at year one, they estimated that 110 employees will leave over the period of 3 years, and there were 100 options, which was valued at 15 rupees. So they accounted 1/3 of the cost in year one. At the end of year two, they have revised that estimate and they have estimated that 105 employees will leave, and they have considered those many employees, and they have considered the initial cost of option was 15 rupees, for which they'll take 2/3 of that cost should be incurred in the first 2 years. And so later on, what they have done, they have decreased the exercise price. Because they have decreased the exercise price, the cost to the company will increase. Because of that, there is an increase in the fair value by 3 rupees. That fair value of 3 rupees increase will be apportioned over the next 2 years only. It will be a prospective and not retrospective. So the same method follows wherein we will determine the total value of the plan. So in all the ESOPs, what we do at end of each reporting period, we will see what is the total value of that particular plan, and we will see how much should be recognized till that particular date, and we reduce what has been recognized earlier in earlier period. Yeah, so here the first example was the modification to, yeah,
Exercise done in category and employee. Share market price of that share is say 50 rupees.
Hmm.
So for employee, the additional 20 rupees is recognized in the first over a period 50 20 rupees already recognized over the period. This will be added to purposes in the third year or in the first year?
to the employee. No, it is when he exercises it actually.
When he
Exercises, yes.
it will be added to purposes.
Perquisite.
The difference between
Exercise price and the market price. So in the same way, there might be some modifications to the terms as well, saying that like, you'll need to achieve this many particular tasks. So initially in this example, if we see, they have mentioned that the sales team should sell 50,000 units over a period of 3 years or something. Later on, they have reduced the, during year two, enterprise increased the sales target to 1 lakh unit. By end of year three, enterprises actually sold 55,000 units, and the stock option do not vest. So 12 members of the sales team have remained in the employment, and the balance employee have left the employee. So because here the modification is, so they have increased from 50,000 to 1 lakh, right? Because it is determinantal to the employee, we will need to account considering that 50,000 cut thing itself. Even though the statement says that you have increased the target to 1 lakh rupee, 1 lakh units, and the employee might achieve or not achieve that target, but for accounting purpose, we will need to take that 50,000 initial thing. So next is on the cancellation or settlement during the vesting period. So if there is a cancellation or settlement after the exercise period, we will take it to equity shares and our securities premium in terms of exercise. In terms of forfeiture, we will move it to our general reserves. So there might be also cases where there might be some cancellation during the vesting period itself. So some examples might be, the company want to change the plan. So then they might tell that I want to cancel all of this and move to a different plan. Or they might tell that whatever is vested till now, you exercise it immediately. They might reduce the vesting period. So at that point, what we should consider is that, yeah. So at that point, what we will need to do is, so for example, the plan was for 3 years and 2 years has been completed. But at end of 2 years, you estimate that, no, I don't want to keep it 3 years and I want to keep it only 2 years. Then the remaining cost, whatever it is, you'll need to accrue it in your second year itself. Yeah. So if on cancellation, if you are making any payment to the employee, if we are making any payment to the employee, then from the separate reserve account, whatever we have created, that will be used for the payment. And no, cancellation by the employer itself.
That is the payment.
No, cancellation by the employer, and we are issuing them cash. We are giving them cash. So we will tell that we don't want to continue. We will issue cash on this particular date itself. Then whatever has hit to my, say for example, 50 rupees has already hit to my reserve account. We are paying him 50 rupees. So that would be set off. If we are paying him 65 rupees in addition, then that additional 15 rupees would be considered as cost for that particular year.
this we are going to have an expenditure in the books and came in income tax.
So in
This adjustment, nothing will affect profit.
It will only affect the profit and loss.
Profit and loss.
Taxation.
Yeah.
Taxation, you continue paying disallowing the.
so whatever ESOP expense we are hitting to our P&L will be disallowed in every year.
The whole make sure the financial statements are bad. And you pay more tax. You account every year something. Every year something as a don't come. And at the end of 3 years or end of 5 years, okay, you transfer that and give it to employee as an equity.
Correct.
Okay, for which you have not received money.
I mean, so in the year when they exercise, right, that year you can take a deduction of it,
Of what?
of this whatever the expenses. So yeah, year on year, it will the date when the employee actually exercise.
Okay, at that time, what will be the entry?
No, in your tax books that will be allowed.
One shot it will be allowed.
No, sure, it not allowed.
So yeah, actual will be allowed in a tax book.
Correct. See, this portion of India's adjustment, so not India's, ESOP adjustment will be added every year.
Correct.
So as notional item.
Correct.
Then will be allowed on special expense.
In the year when it's exercise. Yes. Correct.
It will be adjusted in deferred tax year on year.
Yes, deferred tax.
Deferred tax will affect year. In the year of exercise.
Yeah. So it is just to avoid, you will incur expense for 4 years, and at the end of 5th year, if employee doesn't exercise or forfeit, then it will be like you're taking allowance in your income tax, but at the end you're just transferring from reserve.
So in the year of exercising, the whatever is already provided in the books. And
Yes.
that
will
allowed as an expenditure.
Expenditure.
So during that time, in the example, so 30 rupees is excise price. So 15 rupees is already provided in the books. So it becomes 45.
Correct.
Market value is 60.
Correct.
Now I will expense 15 rupees, which is already provided in my books. And then there is additional 15 rupees which employee is getting the benefit as.
Perquisite.
That's also an expense in the books.
Sorry, I missed
I
it.
will expense 15. I've already expensed 15.
Correct.
Already expensed 15.
Correct.
That is added when I give some provision.
Hmm.
I'm given excise price as 30 rupees.
Okay.
45 is the amount which is going to come to me. 115 already is coming.
Correct.
So
Correct.
30 rupees will come in cash.
Correct.
Market price is 60 rupees.
Okay.
45 is already coming to the books. Balance 15 is not come yet.
Correct.
But employee will pay tax on this 15 as per percent.
Perquisite. Yes.
That's also an expense in the books.
Yes. In the year when they exercise. Yes. So because on the
Money to 60 and then
yes.
premium.
Yes. Correct.
10 rupees face value, 50 rupees.
50 rupees premium. So because on the date of grant or on the end of vesting period, we would not know what would be the future market rate. So on the exact date on the market rate, we will see what is the difference between our exercise price and the market price. That value will be as a perquisite to employees, which will be taxable there. And also in our books, whatever is the difference between actual cost which we have incurred and the balance, will take it to P&L, and the whole amount will be allowed as an expenditure in the year when they actually exercise.
But employee has to pay perquisite on the balance first 15 as well as last 15, right?
Yes, both.
He has to pay on 30.
Correct. So that will again be like a salary itself received in terms of ESOP in kind. Yep. So next we have, initially we have discussed all about the equity settled share-based payments. Now we have cash settled share-based payments. So even here in cash settled share-based payment, the recognition principle remains the same. If it is goods, then you will recognize it at point in time itself. If it is services from employees, then over the vesting period. And if it is services from others, over the period of services. In terms of measurement, what is the measurement criteria which we use to value the consideration which we give? So here we will measure the fair value of the liability itself. That is the fair value of cash which we are going to pay to them. That will be measured for our valuation. So vesting period is as well the same thing, wherein only market conditions would be factored by the valuer. Other than market conditions, we will need to take it in our valuation, year-on-year estimates. Over the vesting period, we will need to take it and account for it accordingly. So after the vesting date, the liability will be adjusted on the exercise date to whatever cash you're making payment to. And in case the actual cash you're paying is more than the liability amount, that a particular amount will be considered as service received in that particular year, and you will pay the whole amount. So here there is one example. Say, for example, so enterprise has issued 300 stock options to them, which will be in cash settled to each of its 1,000 employees, the same example which was used earlier, and the vesting period, exercise period, the estimates, everything remains the same. So here is how is the fair value. So in terms of cash settled, what happens is the fair value needs to be measured every year. So in terms of our equity settled, what we used to do, we used to take the fair value on grant date and we used to just apportion it over the period. But in our cash settled, what we do is we'll need to take the fair value at end of each reporting period. We'll need to get the value done at end of each reporting period. And the accounting treatment remains the same. So for example, in year one, right, we had that same thing. We have estimated what is the total number of options that would be vested, and 1/3 of that will hit to my P&L account. And in year two, what happens? Only the fair value will change, fair value estimate. So in our equity settled, we had taken one particular price, but in cash settled, year on year, considering the change in the fair value, that will be taken into factor, and 2/3 of that will be incurred as the cost till date. So the same accounting treatment actually carries. And here, what happens when the actual cash is paid, right? For example, here, if we see in this example, in third year was the last year for our valuation vesting period, and the fair value of the option was 19.2. So we have taken a cost of 19.2 rupees till the end of third year, but the actual intrinsic value of the share was 16 rupees. It means that we are paying them only 16 rupees at the end of third year. So we would have promised them saying that we will pay based on the intrinsic value of share. The actual payment would be only 16 rupees. So let us assume out of the total 1 lakh employees have taken it. Then we would calculate what is the value of the intrinsic value for those 1 lakh particular shares at the 16 rupees. And for the balance employees will still carry at this value itself. At the end of the period, after all the options are exercised, if there is any balance left in the equity reserve portion, that will be transferred to my reserves.
You have to take intrinsic value only, not the fair value.
Yeah, so for our year-on-year cost, we should take the fair value, but the payment will be made in intrinsic value. So we will calculate the intrinsic value of payment made, and that will be reduced from the actual liability created year-on-year. Yeah, so here entry to be passed at each of the year will be, we have the common expense, employee compensation expenses account debit to provision for payment of tax. This will be a liability which we will go on incurring, and when we actually make the payment, right, the provision would be debited. That's my liability would be reduced and we will make the actual payment. This will be the entry which we will pass year on year and at the time of payment made to the employees. So next comes the share-based payments with the cash alternatives. So here we have two components. One will be with the employee and other option will be with the employer. So say that the option is with employees. So here we will have two components. So when there is an option with employee, at the initial period itself, we can't estimate that saying that, no, all of my employees will go for equity share itself, or 50% of them will go for equity shares and 50% might go for the cash value or something. So this particular estimate cannot be made. We will need to record both a liability component and as well as our equity component. And the next alternative would be option would be with the employer. So in this case, employer needs to determine at the beginning of the period itself, what will he do after the end of vesting period, whether he will settle it in equity shares or he will settle it in cash. Yeah. So on settlement, there might be two options. So when the option is with the employee, On settlement, we would have recorded both liability and the reserve portion. But the employer might either settle in cash or he might ask for settlement in equity. So there might be two particular scenarios. So in first scenario wherein it will be settled in cash, then what will happen is all the reserve portion will be transferred to my general reserve, and to that extent we will need to increase our liability and payment should be made from liability to my equity shares. And when it is settled in equity, all the liability portion and the reserve portion will be used for my payment. I mean, yeah, equity shares. So here we have an example saying how it will. So this will be the actual scenario, how they give. So here enterprise grants to employee the right to choose either a cash payment equivalent to value of 1000 shares or 1200 shares. So if he is settling in cash, then it will be equal to 1000 shares or which will be equal to 1200 shares. So the grant condition upon the completion of 3 years, here they have a vesting period of 3 years, which needs to be completed. If the employee chooses the equity alternative, the shares must be held for 3 years after the vesting date.
Yes.
Yeah, yes, they will need to hold the shares for the next 3 years as well. So here, the enterprise needs to obtain two valuations. The valuation, one is what is the equity component of it and what is the liability component of it. So at the grant date, fair value of the share of the enterprise without considering post vesting restriction is 50 rupees per share. At the end of year 1, 2 and 3, said fair value of the share is 52, 55 and 60 rupees per share respectively. So after taking into account the effect of post vesting transfer restriction, the alternative might come to 48 rupees. So here we will see how the accounting would be made in each of the years. So here 1200 shares were granted. And in terms of equity, if it was an equity settled, then the total cost would be 1200 shares into 48 rupees, which would come to 57,600 rupees. In case it was to be settled in my cash on the grant date itself, when we value, it will be 1000 shares into 50 rupees, which will be the cost. So if it is settled in cash, my total cost would be 50,000. If it is settled in equity, my total cost would be 57,000. So basically in this total, this would be considered as a hybrid thing, and my equity component would be equal to the difference between the total fair value of equity minus total fair value of the cash settled. So that will be 7,600. And the balance 50,000 would be considered as a cash portion. So this 7,600 what we have, this will be apportioned over a period of 3 years. This will be considered like similar to share-based payment in equity. And the balance 50,000 would be considered like a share-based payment which will be settled in cash. So this, when we consider it as settled in cash, the valuation needs to be done at end of each reporting period. So here, when we see how the valuation is done, so this valuation is required for the cash settled. So assuming it will be settled in cash, at the end of year 1, the price of the option was 52 rupees and there were 1000 shares. We will accrue 1/3 of the expense, which will come to 17,330. And there was no provision at the earlier, so whole of 17,330 will be hitting my P&L in first year. And at the end of 2 years, the fair value of the cash portion was 55 rupees if it was settled in cash. So we will accrue 2/3 of it. Should be recognized over a period of 2 years. That will come to 36,667. Out of that, 17,000 was already incurred in my earlier year. So balance 19,000 will be incurred, and in the same way we will create it for third year as well. So this is on the equity. This is on the cash portion. We have calculated what was the equity portion of that. That comes to 7,600 rupees. So this whole 7,600 rupees, 1/3 of it should be accrued to my P&L account, irrespective of our change in estimate, whether they'll take it in cash or in equity. So after this comes the actual exercise period. So in the exercise period, there might be two scenarios. The employee might actually go for the actual cash incentive, or they can go for an equity settled. So when they go for cash settled, what happens is that our valuation at end of year 3 was 60 rupees and the actual exercise price will be 60 rupees. So whole of the 60,000 would be in my liability. It would be like, directly debiting my liability to bank, whatever we are paying to bank, and the whole liability would go off and it would be settled in cash. And whatever was outstanding in my reserve account, that will be transferred to my general reserves itself. The next scenario is that in case they take it in equity, but we have incurred only 6,000, I mean 7,600 has hit to my share option outstanding account. So when the actual employee takes in shares, then what happens is that we debit our share option outstanding account only to an extent whatever is there. We debit the balance of liability, and the balance we take it to share capital and securities premium and the general reserve.
The balance.
Yeah. So next is on the share-based payment among the group enterprises. This was one of the main thing for which they have brought in this revised guidance note, wherein shares might be issued by one group entity to the employees of another group entity. So here, the measurement, accounting, and recognition is done by entity which received the goods and for which the entity pays the share-based payments. So, for example, let us assume that there is a holding company and there is a subsidiary company. The holding company is issuing shares to the employees of subsidiaries company. So it is the obligation of the enterprise of both holding company and the subsidiary company to recognize the expense. Yes, both of them should recognize, irrespective of whether there is cross charge or not. No cross charge.
Double recognition.
Sorry.
With double recognition?
Yes, yes. So both of them should recognize the cost. So earlier.
Double effect on consolidated.
Correct. No, in consolidated books, there is a different treatment. Yes.
But
in a standalone.
It's in an equal manner, not in a proportional manner.
Sorry, both.
Wording only. No.
Correct. Both. No, subsidiary also should account.
Both account equally. When equally, not even half and half.
No. Both should do the assessment on it separately, and they will need to account.
So it means the total amount is considered.
Correct. Total amount is considered.
So subsidiary, though the ratio I hold in subsidiary is 51% of subsidiary.
That doesn't.
Still I have to account.
Correct. So the rationale for this is that the holding company is issuing shares to employees because they have provided service to its subsidiary companies, right? Just because provided services to subsidiary, instead of the subsidiary investing in the subsidiary, instead of holding company investing in the subsidiary, they are directly paying the expense of the subsidiary company. So say for example, an employee has provided service to company, subsidiary is telling that I don't have cash to pay, and the holding company is telling that, okay, I will pay shares on your behalf. It is that instead of the holding company paying it to subsidiary in terms of additional investment or something, they're directly paying it to the subsidiary's employees.
Subsidiary decided to do its own by itself, then holding does not do that.
Yes, that will be like a normal transaction. Consolidation will have an effect. So here we have a example, different scenarios. So the first scenario is parent grant equity shares to employees of the subsidiaries. So then in the consolidated financial statements, here what happens is the shares which are going out will be the shares of the subsidiaries. So that will be considered as a minority shares which are going. So in the consolidated financial statement, it will be considered as an equity settled share-based payment, and accounting will be done wherein only one cost will be incurred, not both the parent and the subsidiary related cost. And next in parent financial statement, it will be considered as an equity settled share-based payment because it is settled in equity instrument of the parent company. Because the parent is issuing its own shares to the employees, it will be considered as equity settled because they are issuing the shares of the company. In terms of the subsidiary financial statements, so subsidiary financial statement, what they does is that they're receiving the service, but they are not a party to the agreement, and they are not issuing shares, or they're not getting cross-charged, or they're not issuing any shares. Despite that, they will need to account this as a equity settled share-based payment.
Same accounting and keep it in the reserve.
Yes, they will need to keep it in the reserve.
Then once it is done, then move it.
Sorry?
Once the vesting is done.
Yes. Yeah. Once the exercise has been done.
That's also
Yes.
in this kind of a case, the parent company is issuing its shares, subsidiary company is not issuing the shares, they're just recording this one. So here, what happens when the difference, like 30 rupees excise price?
Correct.
Parent company has decided.
Okay.
So, pay 60 rupees is the advantage value of the parent company here.
Mm-hmm.
So, he's paying another 10 rupees.
Yeah. So that will be considered like an indirect investment by holding company in subsidiary company.
cross-check?
So, for example, here, let us consider that, the holding company is paying directly to employees shares worth rupees 100 rupees for exercise price of 50. It means that they are giving 50 rupees to them free of cost. So, it is the standard tries to say is that the subsidiary company has received 50 rupees worth service from the employees, and we have recognized a total cost of, say, let's 20 rupees or something over a period of 2-3 years. The balance 30 rupees should be as an expense in the final year in the books of subsidiary.
Subsidiary. Other expenditure.
Yes.
But it is not cross-charged.
No, so irrespective of the cross charge, they'll need to accrue it.
It is approved and moving to
Yes. Not allowable in income tax. Income tax allowable amount will be only if there is a cross charge. Whatever you're cross charging, only that will be allowable. Yes. If we are cross charging, that will be allowable in my tax books. So say, for example, here, every year we are hitting our P&L with 100 rupees. In our tax books, what happens is every year that 100 rupees will be disallowed. At the end of third year, the employee actually exercises. Then we are paying this 100 rupees to holding company if there is a cross charge. If there is a cross charge, if we are paying, then that will be allowable. If there is no cross charge, then it will not be allowable. So basically, it will be based on the actual cash spent.
how do they pay?
Yes.
Will we pay to them?
Yeah.
Parent company.
Correct.
How about perquisite investing?
Yeah. So in terms of the perquisite and all, in the hands of employees, you are asking in hands of employees, right?
Employer has to do. Who is the employer to do perquisite here?
Employer will be the holding company itself, giving the perquisite.
So he will issue a separate form.
No. So he will, it will be like the perquisite given by them, but it is responsibility of the subsidiary company to deduct tax.
So again, it will be taken care by subsidiary.
Correct. It will be taken care by subsidiary itself.
Even though they don't account any expense.
Even they don't account any expense, you will need to deduct tax on behalf of your holding company, remit it to the government, and you should take a reimbursement from your holding company. Say like, your holding company directly issues shares worth, perquisite worth 100 rupees, wherein you're not a party to the transactions. It is you're not cross-charged also. So the standard says that you'll need to deduct this 10 rupees and remit it to government. Actually, you're not paying him anything. Only your cash outflow will be paying 10 rupees to government. You're incurring an additional cost. So this can be reimbursed from your holding company. This needs to be reimbursed.
So it is a responsibility of the subsidiary company.
Yes. It's the responsibility of the correct. It's correct. So basically, even the subsidiary needs to know that whatever plans are given by holding company to their employees. So in most of the cases, the subsidiary company finance team or somebody might not know if there are any shares issued by holding company directly. It is their responsibility now to know if there are any shares issued and if they are exercised, and it is their responsibility to deduct TDS.
During the initial locking period, today at granting, vesting happens only after you complete 2 years in the company. So for this 2 years, in the accounting,
Yeah, cost needs to be recognized.
so for the first 2 years where vesting is not yet started. Vesting is not yet started. Grant is given.
Okay.
You hope stay in the company for 2 years.
Okay.
At the end of 2 years, you will get 10%.
Correct. So that period only will be considered as vesting period, right? So from the date of grant till the date of exercise, that whole period will.
Filling when it vests to you.
Mhm.
Yeah, vest starting.
Exercising, correct. Till the end of vesting period, we should take the cost.
So, 2 weeks. So today I'm granted.
Mhm.
Vesting happens only after 2 years. So you.
Correct. Over the vesting period, cost should be recognized. Over the vesting period. Yeah. So there is one more scenario wherein subsidiary grants its own equity shares to its employees. So this has nothing with to be held with group enterprise, because it's that company issuing shares to its employees. And yeah, even in parents' financial statements, there'll be no impact. There'll be only impact in consolidated financial statements and subsidiaries. In consolidated financial statement, what happens is that the parent, so if parent is holding 100% share in subsidiary, but the subsidiary issues ESOP to its employees, then what happens? There might be a portion of minority interest that needs to be accounted for in consolidated financial statements. That's it. And it would be treated as a normal transaction in the subsidiary financial statement.
Will not come under group.
Yeah, it will not come under the parent because parent is not a party to us. Yeah. So next would be parent grant equity shares of subsidiary to some subsidiaries employees. So the first case which we saw is a parent issuing its own equity shares to subsidiaries. The parent might also issue shares of its subsidiaries to subsidiaries employees. So both the cases are same itself. The only difference is in terms of accounting in the parent financial statements. In parent financial statements, the first transaction was considered as an equity settled because their own equity shares are getting diluted. But here they're issuing these subsidiary shares to its employees, right? It will just be like an investment in subsidiary company. It should be accounted for as an investment in subsidiary company. So there might be a case wherein parent might grant cash based on the value of share of parent shares to their employees. So the treatment, the accounting treatment and everything would be same. Only thing is that they will need to account on this cash based or the equity settled based on the original criteria which we have discussed earlier. So some of the companies might have a trust wherein, like, they might have a separate trust to handle all the share-based payments. There might be different cases. So the first case might be the enterprise shall allot shares to trust as and when employee exercise stock options. So instead of the company directly paying it to the employees, they might transfer it to the trust and trust might transfer it to employees. This might be one case. One more case might be a situation wherein, like, trust might transfer the shares at the beginning of the period itself, irrespective of whether the employee exercised or not. So in all of these cases, what we will need to consider is that we should keep it in isolation. We shouldn't consider that there is a separate trust which is maintaining, and we should account for based on the normal principles of equity settled or my cash settled share based payment.
What is the role of this trust having done?
Okay, so
Doing everything as a company and point of view.
correct.
Why is it trust there? Only to give an agreement.
So they don't want to enter into this compliance part.
Get additional order.
Provisioning entry will come no, in company.
Yeah, company books, it will, everything is same.
Shares of the company only issues, not
Company only issues it.
Trust
Instead
will
of
only
we
make
receiving,
documentation.
yeah,
We
I
tell
mean,
some banks, they will do the document.
Like it's a committee for the
correct.
committee for the subcommittee. Trust.
Yeah, I mean, same in terms of gratuity as well, right?
Yeah.
Instead of the company investing in different schemes, they will make a trust and keep it.
At least there's amount involved.
Correct. At least there is amount involved. Here it's all about a notional entry which is passed.
Yeah, you can call it a committee.
So next is on the EPS implication on this particular ESOPs or RSUs which are issued. So first is on the basic EPS. So basic EPS will not get impacted till the date of exercise because it's all the notional shares which are issued at all. But whereas it will diluted EPS will get impacted from the date of grant itself till the date of exercise. After the date of exercise, anyways, it will have impact on both of these. So let us take an example as to how we will need to calculate the diluted EPS for measuring this particular ESOPs and all. So let us assume at beginning of year 1, enterprise grants 300 stock options to each of 1,000 employees, conditional upon employee remaining in employment at end of year 2. Fair value of stock option at grant date is 10 per option and exercise price is 50 rupees. So these are other factors like, which needs to be considered, like the same assumptions, how many people would be in existence and how many people would actually leave the company in the next 2 years and all. So when we see the actual EPS, how we calculate, right, we will need to calculate what are the number of free shares. based on the market value of the shares at end of each year. So here, for example, let us consider the profit before ESOP cost was 25 lakh and 28 lakh in each of the year 1 and year 2. And the amortization of ESOP cost comes to 13 lakh 50,000 in each year. After amortization cost, my total whatever is the net profit which is attributable is 5 lakh rupees in year 1 and year 2 as well, it is 5 lakh rupees. So when we calculate the basic EPS, it will remain the same because there is no impact of this EPS related in my on my basic shares. But when we are calculating the diluted EPS, what we will need to take is we will need to take the impact of the free shares. So here the total number of options which were outstanding were 2,80,000. That is, there were 1,000 employees. Into 300 options were granted, and for 50 employees, they expected the attrition. So if we reduce that, and there is the remaining cost that needs to be incurred, unamortized cost is 5 rupees. So the total, the price of the option was 10 rupees. Out of that, 5 rupees was amortized in first year. Balance 5 will be amortized in the next year. So there is an unamortized price of 5 rupees at the end of first year. But at the end of second year, there is no such future cost which is required to be incurred by the company. So considering this, we will need to calculate the number of dilutive potential equity share. So here in this plan, what happens is that the employee will pay us 50 rupees for exercising it. But whereas the actual market price is 57 rupees as at the end of year 1. So here what happens is that there is a difference of 7 rupees which will account to the free shares. So what we'll need to do, we will need to calculate the total cash which we'll receive. Total cash which we'll receive will be 2,85,000 into 50 rupees on exercise and 2,85,000 into 5 rupees which we will receive in next year in terms of the services. This will be the total consideration which we receive over the period. And if we divide this by the market value as on date, that is the 57 rupees, we will get the actual number of shares which we were supposed to issue in a normal market scenario. But we are issuing 2,85,000 shares. When we calculate by that, it would come to around 2,75,000 shares. So this means that there are 10,000 shares which we are issuing additionally as an incentive to them. So that needs to be considered in my total number of earlier shares. Earlier it was 5 lakh shares. In this 5 lakh shares, we will add back this 10,000 of dilutive potential shares and we will calculate our dilutive shares.
We are not taking the full number of shares.
Yeah, dilutive shares. So at the second year, what happens? We will not take any additional cost which needs to be incurred. We will just take that 50 rupees consideration, whichever we receive, divided by the total market price. So balance of that 10 rupees would be the perquisite which we are giving. That will be considered as a dilutive shares. So in terms of the disclosure, the standard mentions a few disclosures that needs to be made in the financial statements. That is the method used to account, whether it's a fair value method or a intrinsic value method which we are using to account. The SPP plan, the whole plan structure, what all are there in the plan, what are used in your estimates, let it be the vesting conditions, other conditions, the grant date, the mode of settlement, whether it's an equity settled or a cash settled. And year on year, you'll need to give a reconciliation. What was the opening number of ESOPs? What were the additional grants which were issued during the period? Minus how many were exercised, how many were forfeited. We will need to give the number of shares and we'll need to give the weighted average exercise price of each of these shares. So weighted average exercise price will be because there might be multiple plans. There might be one plan with 1,000 shares with 40 rupees exercise price. There might be one more plan of 800 shares with 30 rupees exercise price. So we'll need to give a weighted average price of each of these. And if there is any modification, we will need to give the details of such modification and the impact of it. Also, we will need to give the details of the expense which have been recognized in our P&L account. I think we have, the last two things to discuss on. What was the difference between the IGAP related thing and what is there in the index? So there is very minute difference between what was there in my IGAP versus what is there in my index. So under IGAP, what happens is under intrinsic value method, if the exercise price is not less than the market price, based on the date of grant, no compensation cost is recognized. But whereas in Ind AS, even if it is less than that, even if the instrument would have a value, even if the exercise price is equal to market price on the grant date, then we will need to factor that in our option pricing model and we will need to take into consideration. So this is the difference between our IGAP and Ind AS.
Even in valuation, volatility could be considered as zero, but here.
Yeah, it should.
Say that.
Okay. Yeah, even in terms of the volatility and everything, volatility cannot be considered as zero. But in Ind AS, it can be considered as. I mean, in IGAP, it can be considered as zero, whereas in Ind AS, we cannot consider the volatility as zero. There should be an assumption for the volatility as well.
Even in India, same would be something.
Yes, yes, everything is the same. Yes. So yeah, they have just aligned it with Ind AS 102, share-based payment. So in terms of what was the major difference between guidance note 2005, which was there earlier to now, is that one thing is the scope. Earlier, this guidance note was applicable only to the employees of the company. We have this guidance note is applicable to non-employees as well, in case you receive any goods or services from others. Yeah, and the next one is group-wide share-based payment. So in the earlier guidance note, they haven't specified, like, if holding company issues share directly, it was all left blank, wherein even the subsidiaries wouldn't account for it. But now it is mandatory for the subsidiary as well to account for. And next is on the graded vesting. So ESOP with, if there is a graded vesting condition, it was treated as a single or separate plan as per the guidance note. It was given as an option to the management itself to consider whatever they want. But now it should be treated as a separate plan itself in the graded vesting. Oh, sorry. Yeah. So in the initial year, it will be like a higher cost, and over the period, the cost would go on decreasing. Considering the number of, I mean, if there is a 40% shares which are going vested after 4 years, then the cost of that 40% will be amortized over 4 years. But if there are any 10% shares which will get vested over next year, 1 year, that whole 10% share should be taken to P&L in the first year itself. Yeah, I think. Yeah.
I think almost all questions is completed, I think.
We are taking offline questions.
Online questions. Yeah, thanks. So I think Vipin has asked what is the accounting difference in terms of cash settled and equity settled share-based payment. So one difference is that in equity settled share-based payment, you will get the fair valuation done at the beginning of the period. But in terms of your cash settled, you will need to get at the end of each reporting period because it might change. This is one key difference. And second key difference is that in equity settled share-based payment, your expense is the same. There is no difference in that. In terms of the other leg of the entry, it will hit to your reserve account, equity option outstanding account. Whereas in cash settled, it will hit to your liability account. So this is the accounting difference in terms of the cash settled and equity settled. One is the entry, which there is a difference, and second is a fair value. In equity settled, it's one fair value, and in cash settled, there'll be year-on-year change in the fair value. So from Kamlesh, will this guidance note be applicable to non-Ind AS company? Yeah, Kamlesh. So this guidance note is applicable to companies which are preparing financial statements as per Division 1 of the Act, and it will be applicable to all AS companies, and for Ind AS companies, that is 102 share-based payments would be applicable. Kamlesh has also asked, US company has offered ESOP to employee of its subsidiary company in India, which is not following Ind AS, and nothing is routed through Indian company. Everything is between employee and parent company. In that case, will this be applicable to Indian company? Yeah, Yeah, Kamlesh. So basically, even if there is no agreement, or even if the subsidiary company in Indian company is not a party to agreement, yes, this guidance note is applicable to them, and they will need to account for ESOP.
So the shares are allotted from a foreign company.
Yeah.
Correct. Even if the shares are allotted directly from foreign company, you will need to account for it. It will be like an indirect investment from the holding company to subsidiary company.
Can the Indian company here collect the money and pay to the? No, I'm asking.
Okay, on the exercise.
An exercise price. Can they collect all the Indian?
I think that that doesn't have a restriction, is what I think. I mean, there is no specific guidance on that in the provided in the guidance note. So here, anyways, it will not hit. It is just that we are collecting on behalf of the holding company. I don't think that should have a impact on it, because it is nowhere affecting my profit or loss. It is just that on behalf of holding company, we are collecting and remitting it back to the holding company. So the next one is Kamlesh. US company has offered ESOP to employees of its subsidiary companies in India, which is not India. I think the same one. Yeah. Since there is no separate accounting standards applicable under IGAP for this, can't we take the benefit of not accounting it for in India? So Kamlesh, this guidance note is issued because there is no separate accounting standard which is issued for IGAP entities, and they're in process of formulating a separate accounting standard for share-based payments. Once till the time that particular accounting standard comes in, this guidance note is a compulsory thing for all the AS related companies. Okay, in terms, if you ask, is it recommendatory or mandatory? It's a mandatory thing for all the companies, wherein the grant date is after 1st April 2021. Okay, thanks, Kamesh.
Thank you, Suraj, for an excellent session. There are a lot of points brought out today. It's added points to our knowledge kit of our members. Thank you for your valuable time sparing your sharing in knowledge. I thank on behalf of Bangalore branch of ICA for your time and efforts. I request our secretary Pramod to present a memento to this Suraj.
Thank you, sir. Thank you for the opportunity of taking this. Thank you for giving me an opportunity to take this session.
Thank you. Thank you.